the show for real estate entrepreneurs.
What sort of advice do you have on like vetting these types of deals?
I would always compare to what you're doing today versus what the market's doing. You really want to make sure that you're getting in at a cap rate that you'd be able to get out of. I'm going to tell a story here, if I may. So we gave back $19 million in 2013. And what we were going to do at the time was buy what's called a lot of broadline necessity retail. These are things in parts of Middle America called Alcos. Shopko's not one of them, and Pamida. Shopko has a very bad balance sheet. And these things had been trading at between a 9 and 10 cap, going all the way back to Moses, okay? Until some dentist with a signature loan bought one for a 6.5 cap. And if you know anything about cap rates, you want to buy a high cap rate and sell at a low cap rate because that's inverse to the value. What happened here is this dentist who didn't know anything made a market according to the REIT that was selling it and the broker that was involved. And we had $19 million in equity to buy from this, triple net lease, what we call necessity retail. This is where people go. You're never going to have a drone service in these parts of the country. Actually, AJ, my COO, owns 2 of these things, so we know the asset very well. But he overpaid for it. And I said to myself, I'm going to give the money back. Because if anything went wrong, and they will, I'm not going to be able to sell that at a 6 cap ever again. They're going to want like an 11 or a 12. So that's why we backed out of it. You always need to know how you're valuing these assets before you get into it. Mm-hmm. That's the first thing, because even the best operators in the world are not able sometimes to get out of an over-leveraged, overpaid property. Yeah. And that's where you're going to see a lot of problems happen today in commercial, especially in multifamily, especially in C-class, what we call, and this is, I know I'm going to get a lot of hate on this, but it's going to be a lot of the Class C stuff that people bought at a 5.5 cap. And, we can get into value-added stuff in a second, but this is what's going to happen. And that's going to be really an issue with the smaller balance stuff, say between 10 million and less. Mm-hmm. People overpaid. If AJ, for example, my COO, he is a real estate investor. He sold his multifamily for a price he never thought he was going to be able to get for it. Yeah. From a guy who has no idea what the hell he's doing.
Who just wanted to get in because it's hot.
Because it's hot and it's going to go up further. The problem with this is that what drives value of commercial is rental income. Right. Nothing else. And a lot of reasons why people like and they gravitate towards something like this is because they know that the consumer's already tapped out, right? So if you look at it from an economic standpoint, me being from New York City, living in New York, renting in New York, owning in New York, you spend about 50% of your after-tax salary on housing. The rest you spend on shoes, food, and lifestyle. Right. And once that becomes more than 50%, you can't hike it anymore, because now it's like, well, you know what, screw this, I'm gonna go across the street because that guy's gonna give me economic incentives. He also has a nicer, 2.5 horsepower Whirlpool bath for my wife. He's got a front desk, a newly paved parking lot. And I can get in there for $100 a month cheaper, so I'm just going to move out. And that's what you're going to see is, some sort of a migration, I think, when people who are weak and experienced operators think that they can just go in there and hike the rents. That's never been something. Also, the expense ratios on something like this, much lower. In multifamily, it's 45 to 50%, if you know what you're doing.
And why is it so much lower on these types of properties?
Because these things are they're built to, the tenant improvements have already been put into. They do it themselves for the most part. Yeah. So they come in, Milwaukee Tool knows what they want. There might be some T&I, but they're there for the 7 years, okay? So you're recapturing it back. But it's also sort of like at the time now where if they're coming in at this point, they're probably going to be here forever, and that's actually a good thing for us. So the expenses are you're not really too worried about, there's no toilets here. There's no air conditioner, we know that very well, but there's no heating for each unit that you're responsible for because your tenants don't care to shut the windows and things are going on. There's just a lot of inefficiencies with multifamily that you don't get in other asset classes.
Yeah, it's interesting. That's a good point too.
You've heard the stories like guys flushing concrete down the toilet. That's a couple grand there, right? They're upset with the landlord, or they're smoking cigarettes and minus 20 degree weather with the heat on, with the windows open, and You see this all over the place, but it really comes down to the quality of the tenant that you have and what they do.
Interesting. So that's why you like the office as an investment.
I like multifamily at the right basis. I like workforce housing at the right basis, and that's not a 5 cap for CCAT.
Right.
Okay. I like that much more to where it was traditionally trading at like north of an 8 back in the day. I think that's going to come through. I think there's going to be some distress in that area where you're going to see some people come in, and we've already starting to see some of those things. But getting back to your point, it's not just office. This isn't really office. This is industrial. But I like to have a very steady, credible tenant.
Right.
Okay. Think about it this way: if you were to go to bed at night, pulling the covers over your head, there's another earthquake, say, and you're worried about the end of the world. Are you going to look at your wife and say, "Damn, I'm glad I have 200 deadbeat tenants who could never afford a house if they even tried to," or, "Damn, I'm really glad I have publicly traded companies with balance sheets who pay every month and I don't have to worry about that"?
Yeah.
How would you want to retire? Because everybody thinks just owning something means they're going to pay. It doesn't. That's what we call credit risk, right?
Yeah.
So were you going to trust your retirement on Joe Sixpack having a job tomorrow after he's gone through his second divorce and his kids hate him? Or are you going to bet your retirement on something where you might not get the same high return, but it's much more stable and much more longer duration, what we call.
Okay.
And that's what people want. They pull the covers over their head and they're like, oh.
Yeah.
I mean, there's times I drive past this over here, come from the airport. I'll have like a bad day, but I'll pass by this and I'm like, life's not too bad anymore.
Yeah, exactly.
To watch this full Founders Club interview, click the link in the description below. And while you're here, don't forget to hit that like button and subscribe for future videos.